Howard Marks, Reading the Market Cycles. Market cycles are not charts. They are stories. Stories of people making decisions, hopeful decisions, fearful decisions, irrational decisions. And Howard Marks, one of the greatest financial thinkers of our time, believes that if you want to be a successful investor, you must learn to read those stories. But how does one read something that cannot be seen directly? How do you measure emotion? How do you assess sentiment? How do you understand risk before it becomes visible? Howard Marks spent decades studying exactly that. His philosophy centers on a key truth: economic forces matter, but emotions govern the market. People like to believe they make rational choices. They don't. Investors like to believe they operate with logic. They rarely do. Fear and greed control markets far more than any financial metric. And that's why cycles repeat over and over again. Not because conditions are the same, but because humans are the same. Marks always starts with one foundational question: where are we currently in the cycle? Because if you don't know where you stand today, how could you possibly know where you're headed next? Investors who ignore cycles are like sailors navigating without awareness of tides. You might have the strongest ship, the most advanced navigation tools, and years of experience, but if the tide turns against you, you will still be crushed by the waves. So what exactly is a market cycle? To Howard Marks, a market cycle is not a single movement, it's a rhythm. Expansion followed by contraction. Optimism followed by pessimism. Booms followed by busts. And each swing in the cycle is shaped by how investors feel, not just how companies perform. The cycle begins quietly. Something good happens: economic growth, new technology, lower interest rates. Optimism starts to build. Confidence grows. Prices rise. And then, something changes. That confidence slowly transforms into excitement. Excitement becomes greed. People stop asking, "Is this investment good?" and start asking, "How much money can I make today?" They don't wonder whether valuations are reasonable. They just don't want to miss the opportunity. They chase what others are chasing. Because crowds feel safe. Because when you're making money, it's easy to believe you're right. And that belief, Marks argues, is the exact moment risk begins to rise. Not when the market is falling, but when everything looks perfect. Have you ever noticed that most financial crashes occur right after the peak of optimism? Why is that? Why do investors ignore danger until it's too late? Why do they become overconfident when they should become cautious? Howard Marks says the answer is brutally simple: risk is invisible when you're winning. At the top of the cycle, people forget about caution. Memories of past downturns fade. They invent new reasons to believe that this time is different. All bubbles are built on that same lie. But cycles never disappear. They just hide. And then, they return violently. Because once markets become too overpriced, once expectations become too unrealistic, and once risk is ignored long enough, fear suddenly returns. And fear is always faster than greed. It spreads rapidly. Doubt turns to panic, panic turns to selling, selling turns to collapse. Investors who felt invincible in good times now feel foolish. They sell not because it's rational, but because the crowd is running away. Confidence evaporates instantly. And that's when the cycle reveals its final twist. The moment of maximum pessimism is also the moment of greatest opportunity. Because while fear pushes people out of the market, value quietly returns. Prices fall below what companies are truly worth. Risk decreases. Yet most investors are too afraid to notice. Marks says, you cannot predict exactly when the tide will turn. But you can observe when confidence becomes excessive. You can see when valuations disconnect from fundamentals. You can sense when caution disappears from conversations. That is how you read the emotional temperature of the market. So the question becomes, what should a wise investor do? According to Marks, the biggest mistake is trying to forecast the future with confidence. People want certainty. They want predictions. They want exact dates and numbers. But cycles do not operate on a schedule. they react to human psychology. Therefore, a great investor does not try to guess the next move, he prepares for it. When optimism is high, protect yourself. When pessimism is overwhelming, take advantage. Investing should not be about being brave or fearful, it should be about responding to conditions intelligently. Marx compares investing to driving. If the road ahead looks dangerous, you slow down. If visibility is clear and the road is safe, you accelerate. Why should investing be any different? Yet most people speed up exactly when the road becomes most dangerous. They take maximum risk when prices are highest. They assume the future will look exactly like the past. And that assumption destroys portfolios. Howard Marks built his career by doing the opposite. When others became euphoric, he became defensive. When others panicked, he became aggressive. He never tried to time the exact turning point. He simply adjusted his exposure based on where he believed the cycle stood. So ask yourself, are you aware of where we are today? Are investors more scared or more greedy? Are valuations justified or stretched beyond logic? Is caution present or forgotten? These are the questions Marx believes every investor must continually ask. Because cycles are not academic concepts. They are the heartbeat of the market. Ignore them and sooner or later, the market will punish you. Understand them and it will reward you. And the beauty of Howard Marks' philosophy is this: you don't need to predict the future. You only need to understand the present. Where are we in the cycle? That is the compass every investor should follow. But the map is not complete yet. In the next part, we will dive much deeper into how Marx identifies the emotional signals that show when a cycle is nearing a turning point, and how those who recognize these signs before the crowd gain one of the biggest advantages in the investment world. Will you be one of those who see the storm coming before the first raindrop falls? Or will you only notice the danger when the flood has already begun? Howard Marks, recognizing the emotional signals of the cycle. Howard Marks says that the most dangerous words in investing are "everyone else is doing it." Because when everyone believes something, the pressure to agree becomes overwhelming. Investors don't lose money because they lack intelligence. They lose money because they lack independence. To recognize where we stand in the market cycle, Marx teaches that we must first understand the dominant emotion of the moment. Is it greed, or is it fear? Is confidence becoming reckless, or is pessimism becoming excessive? These emotional conditions leave clues. And Marx has spent decades learning to read them. The first clue appears in language. The way people talk about investing changes as the cycle progresses. In early stages, investors are cautious. They ask difficult questions. They worry about risk. They demand proof. But as the market rises and profits pile up, the questions change. Suddenly, investors stop saying, "What could go wrong?" and start saying, "Why not?" Everybody's making money. They switch from being careful to being careless. They replace analysis with enthusiasm. If someone ever tells you, "There's no risk here," that is precisely when the risk is greatest. Howard Marks says, risk is not what you see on the surface. Risk is what is hiding underneath optimism. The second clue appears in behavior. When people who know nothing about investing begin making money, and when those people start giving investment advice to professionals, this is a sign. When companies with no profits, no experience, and no sustainable strategy attract millions in capital, this is a sign. When people quit their jobs to trade full-time, not because of skill but because they think markets can only rise, this is a sign. It happened in the dot-com bubble. It happened in the housing market in 2007. It happened during cryptocurrency manias. Howard Marks does not believe these events are coincidences. He believes they are psychological patterns that repeat endlessly. Because human nature doesn't change. If humans do not change, why would market cycles change? The third emotional signal comes from valuation. When prices detach from fundamentals, when investors stop caring about earnings or cash flow, when they pay any price simply out of fear of missing out, Marx calls this the triumph of hope over reality. Investors convince themselves that valuations do not matter. They say, "This company is changing the world, price is irrelevant. But price is always relevant. Paying too much for even the best business can turn a great investment into a disaster. Marx often reminds investors, the quality of a company and the quality of an investment are two separate things. A wonderful company can be a terrible investment if you pay the wrong price. The fourth clue of market extremes appears in credit markets. When optimism is high, lenders forget caution. They offer money freely. They lower standards. They give loans to businesses that should never receive funding. Companies borrow simply because they can, not because they need capital. And this cheap money fuels risk-taking and speculation. But eventually, debt becomes heavy. When the market slows, those who borrow too much fall first. Debt exaggerates both sides of the cycle, it makes booms bigger and busts more painful. Marx built his reputation by analyzing credit. He saw early when lending became too aggressive. He reduced exposure while others took excessive risk. And when the crash arrived, he had cash ready to buy from the desperate. The fifth emotional signal appears when people celebrate investing as if it were entertainment. When investing becomes a game, risk disappears from investors' minds. They don't think long term. They want quick wins. They want excitement. They replace discipline with gambling. Howard Marks warns, if you are having too much fun investing, you are probably doing it wrong. So how does an investor resist these emotional traps? By thinking independently. Marx says, you cannot outperform the market if you are the market. If you make the same decisions as everyone else, you will get the same results, average at best, disastrous at worst. The key is to observe the crowd, but not join the crowd. Study their behavior, but don't follow their behavior. Ask yourself, why is everyone so optimistic right now? Why is everyone ignoring risk? Why does everyone believe prices only go up? If the only justification for an investment is other people are buying it, that is not a reason, it is a warning. Great investors separate themselves from the herd. They question what others accept. They remain skeptical when others are confident. They become less excited as markets become more euphoric. They embrace discomfort because the best opportunities often feel uncomfortable. Howard Marks says that the best investors do not run toward excitement, they run toward fear. When others panic, when markets fall sharply, when headlines scream disaster, that is when value returns. But buying in those moments feels terrifying. Which is why only the calmest minds act. The essence of cycle awareness is this: you must act contrary to the crowd before the crowd realizes the truth. Yet being contrarian is not about always doing the opposite. It is about knowing when the crowd is wrong. And that requires deep judgment. Markets do not announce turning points. There is no bell that rings at the top. There are only subtle signs, psychological shifts small enough that most investors ignore them. Until it's too late. Marx teaches that even if you cannot pinpoint the exact moment of reversal, knowing whether the risk is rising or falling gives you a major advantage. If everyone else is speeding up, maybe it's time for you to slow down. If everyone else is paralyzed by fear, maybe it's time for you to carefully move forward. Think of this: what matters more, perfect timing or proper positioning? If you could avoid the worst of declines and benefit from much of the recovery, would that not be enough to outperform over time? Marx believes it is. The key is staying aware. Staying rational. Staying grounded when others lose control. So ask yourself right now, what emotion is dominating the market today? Is greed louder than caution? Are investors ignoring danger signs? Do people brag more about gains than they ask questions about risks? Understanding those answers may be more valuable than any earnings report or analyst forecast. In the next part, we will explore Howard Marks' ultimate skill, turning cycle awareness into real investment decisions. How does he adjust his portfolio when emotions shift? How does he decide when to defend or when to attack? And how can you apply these same decisions to achieve better long-term results? Because seeing the cycle is only the first step. Knowing how to use that knowledge, that is where great investors are made. Howard Marks, turning cycle awareness into profitable action. Howard Marks believes that understanding cycles is only powerful if it leads to better decisions. Awareness without action is merely observation. So, the real challenge begins once you recognize where we are in the emotional and financial rhythm of the market. What do you do with that knowledge? Do you buy aggressively? Do you sell? Do you hold? Do you hedge? There are no formulas that give clear answers. But Marks offers a framework. The goal is not to predict exactly what will happen next, it is to prepare for what is most likely to happen. In euphoric moments when optimism is widespread and prices reflect perfection, Marks increases caution. He reduces exposure to the riskiest assets. He raises cash when others fear missing out. He looks for investments where downside is limited even if upside appears moderate. This is contrary to crowd psychology. Most investors take maximum risk at the exact moment when risk is highest. Why? Because rising prices make them feel safe. But safety in markets is not created by price increases, it is destroyed by them. Meanwhile, when panic dominates and fear fills headlines, Marks does the opposite. He becomes bold. He buys what others are forced to sell. He provides capital when capital disappears. He steps into the storm, not because he enjoys the chaos, but because the very existence of panic means the market has already priced much of the danger. He asks, if this investment survives the worst-case scenario, imagine how cheap it must be today. Yet courage is difficult when emotion screams otherwise. So how does Marks maintain clarity in moments when others lose control? He focuses on probabilities, not certainties. Investing is never black and white. It is always about weighing what could happen against what is priced in. Risk is high not when the future looks scary, but when investors refuse to imagine a bad future. Conversely, risk is low not when everything looks bright, but when everyone fears darkness. And here's the important shift: Marks says great investors don't ask, what will happen? They ask, what is already reflected in the price? If everyone expects perfection, even normal results disappoint. If everyone expects disaster, even small improvements delight. So ask yourself, are you predicting a future, or are you reading the expectations embedded in today's prices? Howard Marks adjusts his offense and defense based on this. When risk is rising, he strengthens defense, more selective buying, greater credit quality, shorter duration, less leverage. When risk is falling due to widespread fear, he increases offense, more equity exposure, more distressed debt, more deep value opportunities. But he never swings to extremes. He avoids all-or-nothing decisions. Because timing markets perfectly is a fantasy. Instead, he makes gradual, intelligent shifts like a sailor adjusting sails based on subtle changes in the wind. You cannot control the storm, but you can align yourself to survive it and even benefit from it. The power of this approach lies in second-level thinking, a core concept Marks is famous for. First-level thinking asks, this company is good, so the stock is good. Second-level thinking asks, this company is good, but is that already priced in? Might expectations be too high? First-level thinking asks, this stock has fallen, so it must be risky. Second-level thinking asks, this stock has fallen, has the risk been reduced because fear is now excessive? Which thinker do you want to be? The one who sees only the surface? Or the one who looks beneath? Most investors try to forecast earnings or interest rates. But Marks forecasts behavior. He watches how people feel. He watches how people act. He watches how quickly conviction turns into euphoria, and how quickly fear turns into despair. This, he argues, is the true source of cycles, not math, not models, but human nature. And human nature is predictable precisely because it is so often irrational. Think of the investors who bought technology stocks at the top of the dot-com bubble. They didn't believe they were gambling. They believed they were brilliant. Think of the investors who flipped houses in 2007, believing real estate prices could never fall. Confidence blinded them. Now think of the investors in early 2009, terrified that the financial system would collapse forever. They believed panic was wisdom. Fear blinded them. Would you have acted differently? Marks says that to outperform, you must sometimes look wrong in the short term to be right in the long term. You must tolerate discomfort. You must embrace contradiction. When fear is greatest, the seeds of recovery are already planted. When confidence is highest, the seeds of failure are already buried beneath the surface. So here is the real skill: do you have the patience to wait? Do you have the discipline to act rationally when emotions rage? Do you have the humility to admit you cannot predict the future, but the courage to prepare wisely anyway? Howard Marks doesn't claim to have perfect foresight. He claims something more practical: situational awareness. And that awareness compounds over time. Imagine avoiding the worst 20% of market losses while capturing most of the gains. Imagine buying when assets are cheap and selling when they are expensive, not because you guessed right, but because you observed the signs others ignored. This is cycle-based investing. This is Howard Marks' edge. And this can be your edge. But only if you recognize that financial success is not just a matter of intelligence. It is a matter of temperament. Can you handle uncertainty without panic? Can you restrain excitement when everyone else celebrates? Can you stay independent when the crowd screams conformity? Marks invites you to become a student of human behavior. Because the market is a mirror reflecting our hopes, our fears, our greed, our insecurity. If you learn to read that mirror, you will always see the cycle before it's obvious. And once you see the cycle, you no longer feel lost inside it. You become the navigator, not the passenger. You control your decisions instead of reacting to headlines. You think clearly while others are drowning in emotion. And over years, over decades, that difference is everything. So as we conclude this exploration of Howard Marks' philosophy, reflect on this question: are you investing with the cycle or against yourself? Thank you for watching this deep dive into Howard Marks and the powerful art of reading market cycles. If there's one lesson to take with you today, it's this: you don't need to predict the future to succeed in investing, you just need to understand where we stand in the cycle and act with discipline while others follow emotions. The market rewards those who think differently, stay patient, and remain rational when it matters most. If you want more content that sharpens your financial mindset and brings you the wisdom of the world's greatest investors, make sure to subscribe to the channel. Join our community of mindful investors, and let's continue growing smarter together.